The stock market is often portrayed as a chaotic arena of numbers, tickers, and fast-moving traders. But at its core, it serves a simple and elegant purpose, connecting businesses that need money with investors who have it. In this chapter, we will explore what stock markets are, how they work, and why they are a cornerstone of modern capitalism. A stock market is a centralized platform where shares of publicly listed companies are bought and sold. These shares represent partial ownership in companies, whether it's a tech giant like Apple or a manufacturing firm in Germany. When you buy a share, you're essentially buying a small piece of that company. The stock market is not a single place, it's a global network. Exchanges like the New York Stock Exchange, NYSE, London Stock Exchange, LSE, Euronext, Tokyo Stock Exchange, TSE, and Tadawul in Saudi Arabia facilitate this marketplace. Stock markets serve two vital purposes. One, capital raising for companies. Businesses issue shares to fund expansion, research, and acquisitions. Two, investment opportunities for individuals and institutions. Investors seek returns through share price appreciation and dividends. When an investor places an order, it moves through a broker to an exchange where buyers and sellers are matched. Prices are determined by supply and demand, affected by company news, economic data, and global events. Retail investors, individuals trading via apps like Robinhood, Saxo Bank, or interactive brokers. Institutional investors, banks, pension funds, mutual funds, hedge funds, market makers, firms providing liquidity. Regulators, authorities like the SEC, USA, or FCA, UK, ensuring transparency and fairness. NYSE, USA, home to giants like Coca-Cola, JP Morgan. NASDAQ, USA tech-focused exchange for companies like Apple, Amazon, Tesla. LSE, UK London-based diverse international listings. Tadawul, Saudi Arabia, Middle East's largest exchange. Euronext, a pan-European exchange operating in Paris, Amsterdam, and Brussels. For economies, capital mobilization. Job creation, increased corporate accountability. For investors, access to wealth-building opportunities, and liquidity and diversification. Stock investing is inherently risky. Prices fluctuate with economic cycles, political changes, and unexpected events. Long-term discipline, diversification, and risk management strategies are crucial. Stock markets connect businesses needing capital with investors seeking returns. Exchanges like NYSE, LSE, and Tadawul play crucial global roles. Prices are influenced by real-world events and market sentiment. Investing requires careful research and risk management. Chapter 2 will dive into IPOs, how companies make their debut in the public markets, and how investors can participate. When a private company wants to grow, innovate, or expand globally, it often needs more capital than it can raise through internal profits or private funding. One of the most transformative ways to raise this capital is by going public, through an initial public offering (IPO). This chapter explains what an IPO is, how it works, and why it matters for companies and investors globally. An initial public offering (IPO) is the process through which a private company offers its shares to the public for the first time. Before an IPO, The company is typically owned by a small group of founders, early investors, and employees. By going public, the company invites outside investors to become shareholders by purchasing its stock on a public exchange. This process transforms the company into a publicly listed entity, subject to increased regulatory oversight, public reporting obligations, and of course, market pressures. There are several strategic reasons for a company to pursue an IPO. Raise capital for growth, expanding into new markets, R&D, acquisitions, repay debt. Provide liquidity to existing shareholders, including early investors and employees with stock options. Gain credibility and visibility in the public eye. And create a market for its shares, enabling easier future fundraising. The IPO process typically involves the following steps. 1. Appointing investment banks, underwriters. The company hires one or more investment banks to act as underwriters. Their role is to value the company, manage regulatory filings, set the IPO price, and sell the shares to institutional clients. 2. Regulatory filings. In the US, the company files a Form S-1 with the Securities and Exchange Commission, SEC. In other jurisdictions, for example, UK, Saudi Arabia, there are similar disclosures required by local regulators. 3. Due diligence and roadshow. The underwriters and lawyers conduct detailed analysis and legal reviews. Then, the company's executives go on a roadshow, a marketing tour to pitch the IPO to institutional investors. 4. Pricing and allocation. Based on investor interest, a final price is set, the offer price. Shares are allocated to investors, often with preference given to large institutions. 5. Listing and trading. The company is listed on a stock exchange, for example, NYSE, LSE, NASDAQ, Tadawul, and shares begin trading under a ticker symbol. Alibaba Group, 2014, listed on the NYSE, raising $25 billion, the largest IPO in history at the time. Saudi Aramco, 2019, listed on Tadawul, raised over $29 billion, now the largest IPO globally. Facebook 2012 raised $16 billion and marked a turning point for social media valuations. Adyen's 2018, Dutch fintech firm listed on Euronext Amsterdam, attracting global investors. Pricing an IPO is part science, part art. If the price is too high, the shares may not sell. If too low, the company may leave money on the table. Underwriters try to find a price that reflects fair value and ensures first a pop, a moderate rise in stock price once trading begins. Traditional IPO, shares are sold to institutional investors before the listing. Direct listing, the company does not raise new capital. Existing shares simply become tradable, used by Spotify and Coinbase. SPAC, a special purpose acquisition company. A public shell company acquires a private firm, effectively taking it public without a traditional IPO process. Investing in IPO can be rewarding but risky. Newly listed stocks can experience large price swings. Information gaps, less historical data may be available for analysis. Lockup periods. Founders and insiders are often restricted from selling their shares for 6 months post-IPO. Early access to a company's growth trajectory. First mover advantage if the company becomes a market leader. Portfolio diversification, especially in emerging sectors. Historically, IPO shares were reserved for institutional investors, but now, more brokers like Robinhood, eToro, or Saxo Bank offer IPO allocations to retail investors, often with certain restrictions or minimums. An IPO is a company's first public offering of shares to raise capital. The process involves investment banks, regulators, roadshows, and market pricing. IPOs can provide growth capital and market visibility for companies. Investors can benefit from early access but must be cautious about volatility and valuation. Today, IPOs are increasingly accessible to global retail investors. In Chapter 3, we'll explore what share ownership really means and how owning equity in a company gives you power, profit, and responsibility. When you hear someone say, "I own shares in Apple," what does that really mean? Does it give them access to Apple's profits, a seat at the table, a voice in how the company is run? In this chapter, we explore the concept of share ownership, what rights it confers, what it means legally and financially, and how it plays out in different types of equity markets across the world. A share, often called a stock or equity, is a unit of ownership in a company. When a company issues shares, it's essentially dividing ownership of the company into small pieces and offering them to investors. If you own one share of a company that has 1 million shares outstanding, you own 0.0001% of that company. Shares are traded on stock exchanges and their prices fluctuate based on market perception, supply and demand, and company performance. But beyond price movements, being a shareholder comes with a set of legal rights and potential financial benefits. There are two main types of shares. Common shares. These are the most widely held shares. They usually come with voting rights and a claim on a portion of the company's profits through dividends if declared. However, they are last in line if a company is liquidated. Preferred shares. These typically don't offer voting rights, but have a higher claim on assets and earnings. Preferred shareholders receive dividends before common shareholders and often at a fixed rate. Owning shares gives you certain entitlements. Here are the most important ones. 1. Voting rights. Common shareholders can vote on key issues at the company's annual general meeting, AGM, such as electing board members or approving mergers. 2. Dividend rights. If a company decides to distribute a portion of its earnings, shareholders receive dividends based on the number of shares they own. 3. Capital gains. If the value of your shares increases over time and you sell them at a higher price, you make a profit, known as capital gain. 4. Access to information. Shareholders are entitled to access financial reports and disclosures so they can evaluate the company's performance. And last but not least, rights to residual assets. In the event of liquidation, shareholders may be entitled to a portion of remaining assets, although common shareholders are paid last after debts and preferred shareholders. Many companies use dual-class share structures, especially in tech. For example, Alphabet, Google's parent, has Class A shares 1 vote, Class B shares 10 votes, not publicly traded, and Class C shares no votes. This allows founders to retain control even if they don't own the majority of the economic interest. Such structures are common in the US, less so in Europe, and generally restricted in some Asian markets. They raise debates about governance and shareholder empowerment. A dividend is a payout from a company's profits to its shareholders. Not all companies pay dividends. Some reinvest profits for growth. But dividend-paying companies, often in utilities, telecom, or consumer staples, attract income-focused investors. Dividends can be paid quarterly, semi-annually, annually. They can be paid in cash, additional shares, stock dividends. For example, a shareholder owning 1,000 shares of a company that pays a $1 annual dividend would receive $1,000 per year. Price volatility. Share prices can fluctuate widely due to external and internal factors. No guaranteed income. Dividends can be cut during downturn. Dilution. Companies may issue new shares, reducing your ownership percentage. Lack of influence. Unless you own a significant stake, your ability to influence company decisions is limited. Being a shareholder fosters a sense of partnership with the company. Long-term investors often develop brand loyalty and become advocates. But this can also lead to emotional decision-making, like holding on to a poor-performing stock due to attachment. Ownership rights and protections vary by country. For example, the US and UK have strong shareholder protection frameworks. In some emerging markets, majority shareholders can dominate boards and minority rights may be less protected. European firms may emphasize stakeholder governance more than shareholder primacy. A share represents partial ownership in a company and entitles you to profits, rights, and risks. Common shares provide voting rights and potential capital gains, while preferred shares offer income stability. Ownership rights vary globally and across companies. Investing in shares is not just financial, it's a long-term commitment and a stake in a company's future. Next up, in Chapter 4, we'll explore how capital flows in the market, from initial share issuance, primary market, to daily trading, secondary market. The stock market can seem like a single, continuous platform where shares are bought and sold, but in reality, it operates through two interconnected segments, the primary market and the secondary market. Understanding the distinction between them is essential to grasp how capital truly flows from investors to companies, and then between investors themselves. The primary market is where securities are created. This is the market in which companies, governments, or institutions issue new shares or bonds to raise capital directly from investors. A typical example of a primary market transaction is an initial public offering, IPO. When a company sells its shares to the public for the first time, it receives the proceeds from the sale, capital that it can use to fund operations, expand internationally, or invest in innovation. Other primary market activities include follow-on public offerings, FPOs, companies issuing additional shares after the IPO, private placements, direct share sales to institutional investors, rights issues. Existing shareholders get a chance to buy more shares at a discount. In all these cases, the capital flows from investors to the company or issuer. Once securities are issued in the primary market, they are traded among investors in the secondary market. This is the segment of the market that most people are familiar with. Daily stock trading on exchanges like NYSE, LSE, NASDAQ, or Tadawul. In the secondary market, no money flows to the company. Instead, investors buy and sell from each other. For example, if you buy shares of Tesla from another investor on the NASDAQ, Tesla doesn't receive your money, the previous shareholder does. Even though companies don't raise new funds in the secondary market, it plays a critical role by 1. Providing liquidity. Investors can buy and sell shares quickly and at transparent prices. Enabling price discovery. Prices adjust based on new information and investor sentiment. 3. Creating exit opportunities. Early investors and venture capitalists rely on the secondary market to realize gains. 4. Establishing market valuation. A company's market cap is determined here, which affects future capital raising terms. primary market. In 2020, Airbnb raised $3.5 billion in its IPO by issuing new shares. Secondary market. Once listed, Airbnb's stock traded on Nasdaq. If you bought its stock a week later, your money went to another investor, not Airbnb. Saudi Aramco, 2019, raised $209 billion in its IPO on Tadawul. This was a primary market event. Aramco today traded daily in the secondary market by regional and international investors. The primary and secondary markets are complementary. Without a vibrant secondary market, investors would be less inclined to buy in the primary market. After all, investors want to know they can exit when needed. Liquidity and confidence in the secondary market directly support the success of future primary offerings. In developed markets like the US, UK, and EU, both markets are heavily regulated and transparent. In emerging markets, secondary market liquidity can be thin and disclosures may be limited, making IPO investing riskier. The primary market is where companies raise capital by issuing new shares. The secondary market is where investors trade existing shares with each other. Both markets play a vital role in the global financial system. Understanding the distinction helps investors evaluate where value is created and where risk lies. Next up, in Chapter 5, we'll explore the world's major stock exchanges and what makes each one unique. When we talk about the stock market, we're not referring to a single, unified marketplace. Instead, we're talking about a global network of stock exchanges, each one serving as a hub where buyers and sellers come together to trade securities. These exchanges are the backbone of the financial system, and each has its own identity, strengths, and role in the global economy. In this chapter, we'll explore the world's most important stock exchanges, their unique characteristics, and their impact on global finance. A stock exchange is an organized and regulated marketplace where securities such as stocks, bonds, and derivatives are bought and sold. It provides the infrastructure for trading, ensures transparency, and facilitates liquidity. Most major exchanges operate as electronic trading platforms today, though some still maintain physical trading floors. Stock exchanges serve several key purposes. Price discovery, they help determine the fair market value of securities. Liquidity, investors can easily enter or exit positions. Regulation, exchanges enforce listing standards and monitor trading activity. Capital access, companies can raise funds through IPOs and follow-on offerings. New York Stock Exchange, NYSE, the world's largest exchange by market cap, home to major corporations like JP Morgan, ExxonMobil, and Coca-Cola. Nasdaq, known for its technology-heavy listings including Apple, Microsoft, and Amazon, fully electronic and fast-growing. London Stock Exchange, LSE, one of the oldest exchanges, home to multinational firms like Unilever, HSBC, and BP. Euronext, a pan-European exchange operating in cities like Paris, Amsterdam, and Brussels, hosts Airbus, L'Oréal, and Sanofi. Tokyo Stock Exchange, TSE, the largest in Asia. Major listings include Toyota, Sony, and SoftBank. Shanghai Stock Exchange, SSE, known for large state-owned enterprises, SOEs, and domestic Chinese firms. Hong Kong Stock Exchange, CAC, acts as a bridge between mainland China and global capital, hosts Tencent, Alibaba, HK Listing, and HSBC. Tadawul, Saudi Stock Exchange, the largest in the MENA region. Saudi Aramco's historic IPO brought global attention to this exchange. Stock exchanges are central to capital flow and economic growth. Each exchange reflects the financial DNA of its region. From the NYSE's global dominance to Tadawul's regional strength, investors can benefit by understanding where companies list and why. Next up, Chapter 6 explores the wide range of market participants, from everyday retail investors to institutional giants. The financial markets are often imagined as places where millions of individuals make small trades that collectively shape prices. While retail investors play a role, the truth is that the majority of trading volume and market influence comes from a handful of powerful participants, the big players. In this chapter, we'll explore who these big players are, what motivates them, and how their actions shape global markets. 1. Institutional investors. Institutional investors are organizations that manage large pools of capital on behalf of others. These include mutual funds, which manage diversified portfolios for retail investors. Firms like Vanguard and Fidelity are among the largest. Pension funds invest retirement savings of workers globally. Examples include CalPERS, USA, and the Canada Pension Plan. Insurance companies invest premiums collected from policyholders to meet future claims. Endowments and foundations, such as institutions like Harvard's endowment or the Gates Foundation, actively invest in global markets. Why they matter: these entities hold trillions of dollars and can move markets when they buy or sell large positions. They also participate in IPOs and influence corporate governance through voting rights. 2. Hedge funds. Hedge funds are private investment vehicles that use sophisticated strategies to generate returns, often with fewer regulatory constraints. Strategies include long-short equity, global macro arbitrage, and quantitative models. Some of the world's most famous hedge funds include Bridgewater Associates, Renaissance Technologies, and Citadel. These funds may take concentrated bets, use leverage, and deploy high-frequency strategies. 3. Sovereign wealth funds, SWFFs. These are state-owned investment funds typically derived from a nation's natural resources or trade surpluses. Examples include Abu Dhabi Investment Authority, ADIA, one of the largest diversified globally. Public Investment Fund, PIF, is Saudi Arabia's aggressive vehicle for Vision 2030. Norway's Government Pension Fund Global is the world's largest SWF, with a focus on ethical investing. Why they matter: SWFs have long-term investment horizons and significant influence on capital markets, infrastructure projects, and emerging market economies. 4. Central banks. While not investors in the traditional sense, central banks like the Federal Reserve, USA, European Central Bank, ECB, and Bank of Japan can influence markets by setting interest rates, conducting open market operations, and implementing quantitative easing. Their decisions impact everything from equity prices to currency values and bond yields. 5. Market makers and high-frequency traders, FFTs. Market makers are institutions like Citadel Securities and Virtue Financial that continuously buy and sell securities, providing liquidity to the market. HFT firms use algorithms to execute thousands of trades per second, profiting from tiny inefficiencies. These players contribute to market efficiency, but can also cause sudden volatility as seen in flash crashes. Six, retail investors. While they may be small individually, retail investors are collectively powerful, especially during market surges like the 2021 GameStop rally. Their growing influence is fueled by commission-free platforms, e.g. Robinhood, eToro, fractional share investing, and access to real-time data and mobile trading apps. Still, retail investors face challenges in access to IPOs, institutional-grade research, and execution speed. The composition of big players differs by region. In the US, markets are dominated by mutual funds, hedge funds, and pension funds. In Europe, there is a large presence of institutional investors and family offices. In the Gulf and Asia, sovereign wealth funds and government-backed institutions are more dominant. These players don't operate in isolation. For instance, pension funds allocate capital to hedge funds. Central banks influence institutional positioning. SWFs invest in IPOs and global infrastructure alongside mutual funds. Their trades and decisions create trends, dictate valuations, and affect portfolio strategies worldwide. Markets are driven by a few powerful players managing trillions in capital. Institutional investors, hedge funds, SWFs, and central banks dominate trading and capital flows. Retail investors are gaining influence, especially in momentum-driven episodes. Understanding who these players are helps investors better interpret market moves and price behavior. Next up, Chapter 7 explores how stock prices are influenced not just by financials, but by news, sentiment, and psychology. Why do stock prices move? One day they're soaring on optimism, the next they're plunging on fear. While valuation models exist, the truth is that prices in the short term are driven by a combination of logic, data, and emotion. In this chapter, we break down the mechanics and psychology behind price movements, helping investors understand what really drives the value of a stock on any given day. At its core, stock pricing operates like any marketplace. Prices are determined by the interaction of buyers, demand, and sellers, supply. If demand higher than supply, prices rise. If supply higher than demand, prices fall. Every trade represents agreement between a buyer and a seller at a specific price, but that price can change rapidly based on new information. Over the long term, a company's fundamentals drive its stock price. Key factors include revenue and profit growth, margins and cash flow, return on equity, and future earnings forecasts. Each quarter, companies release earnings reports, which include financial results and forward guidance. These can cause significant price moves, especially if they beat or miss analysts' expectations. Broader macroeconomic data also plays a key role in stock price behavior. GDP growth, inflation, e.g. CPI, unemployment data, consumer confidence, and central bank decisions, e.g. interest rate hikes or cuts. These indicators affect market sentiment and sector rotation. For example, rising interest rates typically hurt growth stocks like tech, but benefit financials. Markets react quickly to unexpected events. Geopolitical tensions, wars, trade sanctions, corporate news, CEO resignations, lawsuits, product recalls, mergers and acquisitions, and regulatory announcements. Example: A rumor of Amazon acquiring a small company can drive its stock price up 30% in a day, even if the deal isn't confirmed. Emotions play a major role in short-term price movements. Fear and panic can lead to sell-offs, e.g. during crises like COVID-19. Greed and FOMO, fear of missing out, can fuel irrational rallies. Retail investors tend to react emotionally to headlines, while institutional investors may exploit this through algorithmic trades. Even without news, prices can move due to chart patterns, breakouts, support resistance, volume spikes, moving averages and other indicators, stop-loss triggers or margin calls. Large players also move markets with block trades, algorithmic flows, or index rebalancing. Stocks with high liquidity, many buyers-sellers, are less volatile. Thinly traded stocks, often small caps, can see massive swings on relatively low volume. Market makers and high-frequency traders, FFTs, also add complexity to price formation, especially in fast-moving environments. In emerging markets or export-driven companies, global dynamics and currency moves affect valuations. A strengthening dollar, for instance, can reduce profits for multinational firms reporting in USD. Legendary investor Benjamin Graham once said, "In the short run, the market is a voting machine. In the long run, it's a weighing machine. Price is what you pay. Market sentiment. Value is what you get. Business fundamentals. Sometimes the two align. Often they diverge." Stock prices are driven by fundamentals, news, macro data, and human emotion. Prices reflect real-time expectations, not just reality. Short-term volatility often masks long-term trends. A well-informed investor analyzes both quantitative data and market psychology. In Chapter 8, we'll explore stock market indices, what they are, how they're built, and why they're key to understanding markets at a glance. We'll also explain how to trade in practice. Understanding how the stock market works isn't just about knowing what a share is. It's about seeing the big picture and understanding the invisible gears turning in the background. In this chapter, we explore two essential ideas: stock market indices and how trades are executed from start to finish. A market index is a collection of selected stocks designed to track the performance of a specific segment of the market. Indices provide a snapshot of market trends and investor sentiment. Help investors track market performance. For example, the S&P 500 rose 1% today. Used as benchmarks to evaluate investment funds. Basis for index funds and ETFs, exchange-traded funds. S&P 500, S&P 500 large US companies, weighted by market cap. Dow Jones Industrial Average, USA, 30 large industrial companies price-weighted. FTSE 100, UK, top 100 companies on the London Stock Exchange. DAX, Germany, top 40 companies listed in Frankfurt. Nikkei, 225, Japan, 225 Japanese companies price-weighted. MSCI World EM track global and emerging markets. Market cap weighted, bigger companies have more influence. For example, S&P 500. Price weighted, companies with higher share prices weigh more. For example, Dow Jones. Equal weighted, all stocks have the same weight. To invest passively using ETFs, for example, SPY tracks the S&P 500. For diversification without picking individual stocks, to compare performance against a standard benchmark. Ever wondered what happens when you press buy on your trading app? Here's how a trade is executed. Market order, buy sell immediately at best available price. Limit order, buy sell at a specific price or better. Stop order, triggered only when price crosses a threshold. You place an order through your broker, for example Interactive Brokers, Saxo. Broker routes it to a stock exchange, for example NYSE, Nasdaq. A market maker or another investor matches your order. The trade is confirmed. This is execution. Once the trade is executed, the back end kicks in. Clearing ensures both buyer and seller have fulfilled their obligations. Settlement is the actual transfer of money and shares, typically T+2 days globally. In some markets like crypto or real-time FX, this can be instant, T+0. Depositories, for example DTCC in the US, Euroclear in Europe, handle settlement. Clearing houses reduce counterparty risk. Regulators ensure transparency and fairness. Today's markets are powered by speed and tech. Algorithms handle trade routing, high-frequency traders ensure liquidity, and global connectivity ensures investors in Dubai can buy stocks in New York in milliseconds. Market indices track groups of stocks and help investors monitor trends and invest passively. Indexes like the S&P 500, FTSE, and Nikkei represent major economies. Trades involve brokers, exchanges, market makers, and clearing systems. Understanding trade mechanics helps investors make smarter and more confident decisions. Next up in our final chapter, we'll look at common mistakes beginners make and how to get started safely and strategically.
With everything you've learned so far, you might feel ready to dive into the markets. But before making your first trade, it's crucial to understand common pitfalls and build a smart strategic foundation. This final chapter will equip you with the mindset, tools, and steps needed to start your investing journey the right way. The markets can be exciting, but that excitement can also lead to poor decisions. Here are some traps new investors fall into. Chasing trends. Jumping into hot stocks or social media hype without understanding the fundamentals. Overtrading. Feeling like you always have to be in the market. This leads to high transaction costs and emotional decisions. Ignoring risk management. Putting too much capital in a single trade, using leverage without understanding it, or not setting stop losses. Emotional trading. Making decisions based on fear or greed instead of logic. Unrealistic expectations. Expecting to double your money in a month. Consistent returns take time, discipline, and learning. Have a plan. Define entry, exit, and risk levels before placing a trade. Start small. Use small amounts of capital while learning. Journal your trades. Track what you did and why. Review your logic and outcomes. Limit screen time. Obsessing over every tick can lead to impulsive trades. Now that you know what not to do, here's how to actually begin investing. Choose your style. Long-term investing, buy and hold, or active trading, short-term with technicals or news. Open a brokerage account. Choose a regulated broker with low fees and solid tools. Learn the tools, charts, fundamentals, simulators, for example, paper trading. Start with ETFs or blue-chip stocks. SPY, QQQ, or stable names like Apple, Nestle. Understand risk and allocation. Don't risk more than you can afford to lose. Use stop losses and diversification. Set goals and time horizon. Align risk with purpose, income, learning, or retirement. Avoid emotional and poorly planned trades. Start with basics and practice with small capital. Use proper tools and maintain a clear plan. You don't need to be perfect. You need to be consistent. Congratulations, you've completed Module 1. You're now equipped with the foundational knowledge to enter the global stock markets. In the next module, we'll dive into technical analysis, reading charts, patterns, and price behavior to sharpen your entries and exits.